We are still working on our consulting project for Jake. In the last video, we explored his production process. This foundation created in the previous video will help us to now analyze his costs. In a future video, we will be able to help Jake determine how much he should produce and how many inputs he should use. Right now, we need to help Jake decide whether he should buy a wood-fired pizza oven or rent one. To do this, we need to first calculate the economic cost of the two different scenarios. Economic cost is the same thing as opportunity cost. If Jake buys a pizza oven, it will cost him $10,000. The money he would use is currently invested in bonds and is earning 5% annual interest. Also, the wood-fired pizza oven loses about $100 of value each year. If Jake rents a pizza oven, it will cost him $600 a year. Which of these two options has the lowest economic cost? When calculating opportunity cost or economic cost, keep in mind that opportunity cost consists of both explicit and implicit costs. An explicit cost is a direct payment or financial outlay like paying wages, rent, interest, or materials. An implicit cost is an amount that is given up to use a resource that a firm already owns. So in this example, the $600 of rent paid each year is an explicit cost. This is an actual financial outlay. This explicit cost represents the entire opportunity cost of renting the oven. If Jake sells off his $10,000 bond to invest in a pizza oven, he gives up the opportunity to earn $500 interest each year. This is an implicit cost. He also has to take into account the fact that his capital will go down in value $100 each year. The $100 of depreciation is an implicit cost. The total opportunity cost of buying the oven is also $600. The economic cost of both scenarios is the same. A mistake I often see students make is they will assert that if a firm purchases a particular piece of capital, that it will save them money because they will no longer need to rent it. Here they are ignoring the implicit cost of owning the asset. Suppose that Jake asks you whether he should continue operating his business as he currently is or exit the pizza business. He currently is bringing in $121,000 of revenue. He also has hired 2 employees, each of which costs $30,000 a year for a total of $60,000 a year. The cost of ingredients and wood to fire the oven is $10,400 a year. He owns his pizza oven. The opportunity cost is $600 a year. Also, if he did not work for himself, he could earn $50,000 a year working as a restaurant manager. These are both implicit costs. What is Sam's economic profit? Adding up the explicit and implicit costs, we get a total economic cost or opportunity cost of $121,000. This implies that the economic profit will be zero. What does zero economic profit mean? Is this bad news for Jake? What zero economic profit means is that Jake is doing just as well as his next best alternative. If he sold off his pizza oven, putting the money back into bonds that yield 5% each year, and went to work for someone else, he would earn $500 of interest from the bonds and $50,000 in wages. By including these foregone earnings as part of his economic cost, we are making sure his revenue covers each of these opportunities. That is, after paying himself $500 interest and $50,000 in wages, he breaks even. Zero economic profit means he is doing just as well running his business as he would be if he pursued his next best alternative. So when a firm has zero economic profit, the firm still has accounting profit. The reason economists calculate profit differently than accountants is because economists are answering a different question. Economists use the concept of economic profit to compare options. For instance, what would it mean if Jake had negative economic profit? It would mean that his next best alternative is better than what he is currently doing. If firms in the pizza business have negative economic profit, we would expect to see firms exit in the long run. What would it mean if Jake was earning positive economic profit? Positive economic profit would imply that he's doing better than his next best alternative. If firms in the pizza business are earning positive economic profit, we would expect to see firms enter the pizza industry in the long run.